Hello, everybody. Welcome back to Mind Your Money with myself, Jerry Jarzabek, and my longtime friend and business partner, Christi.
Hi, Jerry.
So, here we are.
We are.
Episode number 2. We made it. Hopefully we're going to have a lot more of these, but thank you very much for joining us again for this episode. And if you're new, thanks for jumping on board and checking out Mind Your Money, our financial podcast. I do really appreciate everybody that's given us such encouragement and the kind words, and that you've taken the time out of your schedule to watch this. And many of you let us know what you think, so very much appreciated. Thank you. Today, we're going to be talking about a very important topic. I think, and Christi, I hope you agree with me, that this is one of the most important topics we've been dealing with our whole careers, and that is volatility. Addressing volatility, what is it, how to handle it. So I think this is going to be a very, very important episode.
I agree. Market volatility is really one of the most misunderstood topics in finance, of why is it happening, what it means for an everyday investor, and we all know what it feels like when we see those numbers or the red screen flashing if you're watching the news of market sell-off. So it's really important to know how to work through that and make good investment decisions. And that's where Jerry and I come in with clients too, is really helping people with that emotional aspect of breaking down why the ups and downs are happening. And we'll share with you through some research that we've done why it does happen. And maybe right now you feel like it's the most volatile it's ever been, but we can historically tell you it does happen every year. And I think just now it's more exemplified because of the news. Do you agree, Jerry?
I do. I think just because there is so much more news and it's so available, and you pretty much know everything that's happening almost instantly, it does lead to a lot of volatility. But we did promise you, and we did say we're not going to use jargon on this show. So why don't we start with a very simple definition of what we mean by volatility? Maybe give an example or some way so we know what we're talking about.
Sure. Well, definition, not to get too simple, but volatility really is a measure of how the prices move around in the market. Higher volatility, you're going to see bigger swings in some years. I think about what we've just been going through with the war in Iran. So we've been seeing a lot of bigger swings around gas prices and energy, right, because of this war. And also you're going to have low volatility. So you have high and low, and those will move a little more gradually. So that's really the simplest way. And I think, recently we have seen some more volatility.
I definitely agree with that. It's been very volatile, and probably whenever you're watching this podcast, there's something going to be happening somewhere that is going to make the markets volatile. And I like to think about it, and can I use a very simple way to frame this, if you don't mind?
I don't mind.
I think about this like the weather, and this may be too simple for some of you, but when I think of volatility, I think of the weather. When it's low volatility, it's a very calm, sunny day, maybe 70 degrees, a little tiny breeze, just very pleasant, low volatility. But then when we get into those high volatility periods, well, those are certainly like stormy weather. Not to be too simplified with this, but when you have those dark clouds and you see that rolling in, and then you begin to get the rainstorms and you hear the thunder and see the lightning, that's high volatility. But then again, volatility doesn't necessarily always mean things are bad. What's your thought on that? Volatility isn't always bad, right, Christi?
I agree, and I think living in Cleveland, we all know storms and sun, living by a lake. So any of you that are listening in the Cleveland area, we do see it on a daily basis. When we drive in, our office looks out at Lake Erie. But I agree, it isn't always bad. It is a way to get a price to get into the market. So you think about when it is more volatility, you're getting opportunities. And to keep it simple, it's the price of admission to get back into the market if you've been out for those longer term returns.
So volatility doesn't necessarily mean prices are going down. They can also mean prices are going up, right? So it's not always bad. We think of volatility as always being a negative thing, but sometimes volatility works for you on the upside, which is kind of an interesting way to look at things. What causes volatility? I think that's a big topic, especially when you think about the stock market and investments. What are some things that cause volatility? You want to give some examples?
Sure. There's a few big drivers, I believe, with volatility. One would be economic data. So as advisors, we look and watch the news on what do the job numbers look at. Recently, inflation reports. We've had inflation going down in the last year, or interest rate decisions. We spoke, and we will speak more a little bit about that with the Fed rate decision. So that's one nugget per se, is that economic data that comes across the news that you see that will affect the markets.
I think another one is definitely earnings. The earnings of companies can drive volatility, especially in the stock market. When you hear about, you'll hear this often on different news programs, but they'll say a certain company will be reporting earnings after the close. So it could be a big company like an Apple or an Alphabet, a Microsoft, what have you, and after the market closes, they say how they did for that prior quarter. They say what their earnings were. Here's how much money they made. And if that is highly above or highly below what the analysts thought that company was going to do, that can really move that stock price. So that can really add a lot of volatility, either up and down, depending on what those earnings were, especially compared to what was being predicted that the company was going to do. How about some other big reasons?
I think speaking on that with earnings, you also have in the news every day global events that have been happening, and we're going to share some historical information on other geopolitical events. Recently, we've been dealing with the Iran war. That's the most recent, that's caused some crisis in our market, in our economy, and just created uncertainty. So geopolitically and globally, that is definitely an area that will affect the market. And so it's really important to kind of watch and research through that too.
Yeah, absolutely. Those news and global events can really drive volatility. And then it can also just be what we think about as market sentiment. Sometimes it's sort of the old adage, when the ball gets rolling, meaning when folks begin to feel nervous about the global economy or the events that are happening or how companies are going to perform, that may generate a negative sentiment. And all of a sudden, people will start to want to sell stocks because they're worried, they're nervous. And that will lead to volatility on the downside. And the opposite is true. Sometimes people begin to feel very positive about the markets and the economy and what's happening in the world. And when people are feeling very positive, that can lead to volatility on the upside. So sometimes you can't even pinpoint, and the market does this all the time, sometimes you can't even pinpoint the exact reason why something was happening. In fact, most times you can't. It just tends to be that this is what the market has decided at this point. And what else can amplify volatility?
And I would say, to add on to that, because we were talking about global events and economic data, things that will drive those shifts in the market up or down, and it's amplified more now. So when you see some news that maybe creates that sentiment, as Jerry said, that you're more uncertain about the market, what happens behind the scenes is trades will start to happen automatically. And it doesn't necessarily mean it's you yourself personally selling a stock, but there are so many algorithms behind the market. Back in the day when we started, you're on the floor, you would call in a trade. It's much different now. It's so automatic. And because of those algorithms, the market in that sentiment, it just gets exemplified, and it'll react in milliseconds to news or price changes. So I think that's affecting things too, which automation is great. It helps us be able to make those good trades and do those things automatically for clients, but it also can exemplify something if it's not good. with
Right.
algorithms.
Yeah, so another way they also use the term computer trading for some of that. That there are certain things that just happen, and we are not individually making those decisions. So volatility is definitely not always because individual investors may be panicking. In fact, I think a lot of times in today's world, individual investors are performing a little better. Like they're able to keep their heads when things are going wrong, or the computers may be taking markets one way, but individual investors can look at things and maybe realize, hey, maybe this is a good opportunity, or maybe things are getting a little ahead of themselves on the upside, those type of things. Is volatility the same as risk? What do you think?
Oh, that's a great question. I don't think it is. Not exactly. Volatility is going to measure more of how much something is going to move. And risk is that fear of, in my opinion, of just that chance of permanent loss.
I think you're right on that. I tell clients all the time, I say volatility is a very normal part of investing. And I think most people realize that that you're going to have periods where stocks go up and periods where stocks go down. I think we're all aware of that. If you're listening to this podcast, I'm sure you're somebody that is aware of that fact. Indisputable. Risk, I like to frame risk for clients often as, what's the chance that I'm going to permanently lose money on this investment? Which is certainly possible. You can invest in a risky stock, or you could have the economics go against a company that you're invested in, and you can have it priced down where there is a permanent loss of your investment. That's risk to me. Volatility is really not the same thing. Now, in future episodes, we're going to talk about diversification, and
I was just going to bring up diversification.
Right.
That's a huge part of trying to control that risk, or help to control that risk.
I think you're absolutely right. But the idea there is that if you're diversified, hopefully you have things in your portfolio that are holding up well when other parts of your portfolio may be down. And that's what I think of with risk, is having to sell an investment when it's having negative volatility at the wrong time, basically. So you may need money from your portfolio, and for all these reasons we're discussing, that investment may be down, but you have to sell it. That's risk, that you have to take a loss because you needed to sell that investment at a time when it was down. So that's when we're going to talk so much later.
Can I add to that too? I would say that it's also important when you're investing, if most of our clients are long-term investors. So when you're looking at long-term investing versus short-term trading, that volatility when it's short-term, as Jerry said, and you need the money now, really does add anxiety for an investor. So I think really knowing that balance, which we'll talk more about, of if you're going to need funds, try to be careful with where it is invested. And if you do have a short-term timeline on an investment, openly communicating that with your advisor so they can make sure it's invested in a way so you don't feel, say, the volatility or the risk as much, because you have money set aside for that short-term cash that you need.
That's exactly right. So I thought this would be a nice segue in our podcast and our video that you're watching, is how can you handle volatility? And my whole career, and Christi, I think you'll agree with this, we have been using charts to illustrate some of these points. So we think a picture is worth 1,000 words. So this type of data and information, I think it can really help folks weather volatility, especially on the downside, or not get too excited on the upside if things are, that things are doing well and they're going to continue doing so well. So this help us keep a level head when we're thinking about our investments and the finances. And this first chart I'd like to start off with here. This chart is the first chart I learned about when I started my career 32 years ago. And really what it simply talks about is that markets have powered through lots of previous crises. And things have happened where, for various reasons, and especially in those global political events, that the market has gone down when that happened. But every time we have those events, and I know you'll see this on all of our disclosures, and you'll hear this repeated at the end of the podcast, that the past performance is no guarantee of future performance. However, these type of charts show us that every time we've had one of these incidents and people have felt very nervous and sold stocks and the market's gone down, that we have rebounded. And I just think this graph is very powerful. And you look at some of these events here. I mean, I remember, being a financial advisor through so many of those, like 2000, the dot-com crash, or 2008 when we had the financial crisis. I mean, it's been some of the things we've been through have been amazing, yet the market has continued to go higher over all of these different events. Pretty powerful. You have a chart you want to share with us, Christi?
I do, and I will say, this is a good way. One of the things that we tell investors when they're trying to handle volatility is to zoom out, look at the big picture. So I like this chart that you just went over because it really does help look at the big picture from, we're looking back from the 80s till most recently with Russia, Ukraine. You think about COVID and how the market responded to that. So it is a great graph. The other is that, every year you're going to have declines, large declines. So the next graph I'd like to share is really after large declines, and we have that emotional reaction to maybe want to pull back or put more into cash, those stocks can come back. COVID is a good example, that time frame in our life. Those stocks can recover very quickly. So even though that market turn down is really nerve-wracking and will give you anxiety, but those recoveries are so powerful right after that first year. And you'll see, I think actually COVID was the first example of a sell-off of almost 34%. And there was a lot going on in our world that was scary at that time. So maybe the stock market wasn't the first and foremost in your mind. We were dealing with health issues, family members. It was a hard time. But when you look at the return after that 1 year of 78%, and we were still coming back into the economy at that time. But it's a really good example of how when we have a pullback, how that next year, if you're not in the market trying to time it, it's challenging because you're coming back that next year strong, usually, historically.
Christi, you're so right. And this chart is so powerful. So just to give our listeners a little bit of background who may not be looking at the chart. So during COVID, for the first month when that sort of was really hitting us, February 29th of 2020 through March 23rd of 2020, the S&P 500 dropped 34%. So
and didn't the market shut down a couple days too?
Yeah, pretty scary, very quick sell-off. But a year later, it had rebounded and was positive 78%. Who would have thought that? Amazing. And then within 2 years, it had more than doubled, which is just incredible when you think back on that. And it's just one example of what the market can do. So why do we say these things? Not because we're guaranteed anything. Nobody can do that, of course. None of us have a crystal ball. We've all heard that saying. But the idea is when you can have a lot of good data about the past and how the markets have been reacted to that it can give you some confidence on that if you can be comfortable with your investments, you can get through this and you can have a good rebound. So that's what these graphs are all about.
Absolutely. And again, I go back to COVID because there was so much fear around COVID, but it was a time that it was challenging to keep your emotions in check, I think, during that COVID time frame. But we also need to historically know that when we make investment decisions, they happen in moments of fear. So trying to keep those emotions in check and have that accountability person, whether it's someone like Jerry or I, or your own advisor or family member, that can look at the bigger picture of things. And investing is really a lot about the emotions of it, I think.
You're right. One last chart I wanted to share, and that's just how timing the market can be costly. And this, to me, is very important because it shows that if you were to, and a lot of folks this tends to be something that many people will say is things are getting volatile on the downside. I'm nervous. I want to pull out of the market. I want to go to cash, and I'll get back in when things feel safer.
Boy.
Yeah, that's right. We call that timing the market. We both have dealt with that many times for clients. However, in this graph on the screen, we'll show this, and just to kind of give a quick illustration of what it says, is that if you simply miss the 10 best days of the market over the past 10 years, so this is from January 1st of 2016 through December 31st of 2025, so that 10 years, if you simply missed the 10 best days, you drop your return in half. You give up almost 50% of the return of the S&P 500 because you missed 10 days in 10 years. Now, you may say, but I may miss the bad days. That's the problem. The market, normally you sell when the markets are down or you feel bad about the market. So it's much more likely you're going to miss the good days, the rebounds, because you're selling when the markets are already down and things are bad. So just another piece of food for thought.
And I think we saw that a lot in 2008 and 9 in the crisis, and trying to help clients when they do sell to get back in the market at the right time is really hard. And I think if you have a strategy in place of what you need your investments for and your retirement for, based on your timeline, really trying to stick to that plan, right, Jerry? Even when we see these timing of the markets and selling and buying at the right times, is if you stick to the plan, and we'll talk more about diversifying, but if you stick to the plan, whether it's your financial plan or what your goals are for that money, kind of it takes all that uncertainty out of it because you have a longer timeline, right?
Absolutely. So having a plan and sticking to the plan. You talk about the fundamental message of this episode. That's it right there. Have a plan and stick to the plan. And I think that is really what's going to help our clients and you, our listeners, viewers, do well with your investments and your finances. Have a plan and stick to the plan. What do you think?
We have a couple examples, a quick example too, right, Jerry, outside of what we were talking about historically. And that being, I have clients, and maybe you're someone that looks at your investments every day. You log into your Baird online or log into your 401k plan, and you see lots of up and downs in those movements. And that's, again, the volatility aspect of things. Jerry, what do you suggest, or for someone that's listening that does do that?
I just think the most important thing is just try not to get too emotionally invested in day-to-day movements of the stock market. Again, these are things that sound simple. I know they can be difficult sometimes, but when you're logging in and you're checking your investments every day, that can really make you feel, it'll heighten the volatility. It'll make you feel like things are even worse than they necessarily are, or potentially better than they are. So I just think if you're going to look at your values, just try to be relaxed about that as much as possible. Obviously, that's a hard thing to do.
Know that
easy to say.
The markets, this is expected. This is an expected part of the markets. It's part of your payment to get into the markets is kind of that volatility. But that we know it does feel scary, but it's normal. And understanding it and us helping you understand that is a really good first step towards being more confident in your investments.
I think that is a great wrap-up of episode number 2. Understanding volatility, knowing that it's a normal part of investing, and don't let volatility drive your decision-making. Anything else you want to add to that?
No, I just wanted to thank everyone for joining us. And we will have episode 3 coming out, and then we're going to do these episodes monthly. If you have enjoyed today's conversation, make sure you share all the things that are important to do to keep growing, being able to talk to you guys. And also, if you have ideas of things that you're concerned about or that you think would be good topics for Jerry and I, please share those with us. We want to be here for you guys, for our clients, for everyone listening. So let us know of any ideas you have that you think would be helpful.
Yeah.
Jerry.
Thank you so much for joining us here in episode 2. And final thank you to our producer, Katie. Once again, wonderful job. Thank you.
Thank you, Katie.
She does a great job of helping us put these together, and we're very grateful. See you next time.
See you. Have a great weekday. See you soon.
This broadcast contains the current opinions of the hosts and are subject to change. The broadcast is provided for informational purposes only and is not a complete analysis of every material fact regarding any company, industry, or security and should not be considered investment advice or recommendations. Investors should obtain professional advice before making investment decisions. The information has been obtained from sources considered reliable, but its accuracy is not guaranteed. Past performance is not indicative of future results, and diversification does not ensure a profit or protect against loss. All investments carry some level of risk, including loss of principal. Baird is not a legal or tax service provider, and you are strongly encouraged to seek the advice of the appropriate professional advisors before taking any action. Investors should consider the investment objectives, risks, charges, and expenses of each fund carefully before investing. This and other information is found in the prospectus and summary prospectus. For a prospectus, please contact your financial professional and read it carefully before investing. This broadcast may not be reproduced without express permission of Baird. Robert W. Baird & Company Incorporated is a registered broker-dealer and investment advisory number. Member of FINRA and SIPC.